Welcome to the Billion Dollar Banker Podcast, a show built for high achievers by high achievers. This is where top entrepreneurs, real estate professionals, investors, and leaders come to level up their mindset, master their craft, and learn proven strategies from those who have already paved the way. So whether you're chasing your first million or you're looking to scale your business, this is your space for actionable insights, inspiring stories, and the edge that we all need to win. So thank you guys for tuning in today. I'm so incredibly excited to have this guest with us. I was just sharing with him that I'm glad I didn't stop following up with him. It's been a push to get him on, but I know how incredibly important this topic is and how much it's really going to help our audience. We have a lot of entrepreneurs and business owners and people in real estate and finance. And I'll introduce Karlton Dennis to each of you. He's a renowned expert in tax strategy and dedicated to helping individuals and businesses minimize their tax burden through strategic planning and a thorough understanding of tax laws and regulations. Is something we all need, right? It's one part is making the money, the next part's trying to keep it. That is very difficult. So he does this by implementing tax savings techniques. Karlton Dennis obviously also aims to reduce your taxes and ensure long-term financial health. Sounds like music to all of our ears. Welcome to the show, Karlton.
Wow, that was such an incredible intro. Thank you so much for having me on, Nicole. I'm excited to be here, and hopefully we can help some of your listeners save some money in taxes today.
Absolutely. So I really want to jump right in, but if you could tell us a little bit about your background, how tax alchemy came about, I think that would be a great start.
Yeah, so quick background. Most people, when they find out that I'm a tax strategist or a, tax professional, they think I went to school for accounting. I actually went to school for kinesiology. I went to Cal Poly San Luis Obispo. Absolutely loved it, by the way. Didn't end up doing anything related to kinesiology. Got a job in sales, took the sales skills to my mother's company. She had been running a tax and accounting business for over 30 years. So I was able to bring new knowledge, new sales skills to her practice. And that's kind of my first taste of filing returns and understanding tax and tax strategy. Shortly after that, I got my enrolled agent's license, discovered that YouTube is a powerful search engine, and no one really puts a whole lot of tax information on YouTube. So I decided to put a lot of tax information on YouTube, not about filing returns, but how to save money on taxes. What are the strategies that the rich and the wealthy are using to pay the least amount of taxes possible? And I wanted to pull back that curtain. That led to me creating Tax Alchemy, our now tax advisory company that really works with those higher net worth individuals that, are kind of tired of writing massive checks to Uncle Sam or having, a whole person's salary go in the form of a payment to Uncle Sam every single quarter. That just doesn't sound right. So we end up working with those clients to come up with strategies to help them minimize their liability before they go to their CPA's office to file a return.
That's incredible because obviously billion dollar banker, I've been in the banking mortgage finance industry for almost 20 years. And a large part of what we talk to all of our clients about is the fact that, many people that are self-employed, that's the goal, to show as little income as possible. And we have some phenomenal solutions for clients like that, which, you see quite a bit. But, it's interesting because one of the things we want to do as entrepreneurs and business owners is really figure out the best structure for ourselves, our business, our family, our finances. You often say taxes are an entrepreneur's biggest expense. If we flip that thinking, what mindset shift needs to happen for business owners to see taxes not as a liability, but maybe as some kind of an investment strategy?
Yeah. So taxes are your biggest lifelong expense. It's not your mortgage payments, not those fancy vacations that are going to stack up over the years. It's going to be taxes. And what most people choose to do is they choose to do the easy thing, which is I'm just going to go make more money and hopefully I can just outpace what I pay in taxes. You can't ever outpace what you pay in taxes. You have to eventually turn over and look at the fact that the only way that you're going to be able to continue to grow is if you put a little bit of focus on the tax code. And so I help entrepreneurs by understanding the differences between tax preparation, just showing up to your CPA's office and filing returns, versus actually planning for your taxes. Because when you start planning for your taxes, you can start to shift some of the money inside of your business into the right types of investments, whether it's real estate, oil and gas, you name it. And these types of investments actually can give you cash flow while simultaneously offsetting some of that tax that you're experiencing by being a self-employed business owner.
Amazing. And so, we'll just take this down to, I'd say probably most people today are just going to file their taxes once it's time to do it. maybe just taking it up against that deadline, getting everything in and just hoping for the best. If someone were to come to your firm, and if you could explain to us kind of how you work with people, how often are you strategizing, and what's that initial consultation look like if someone's like, here's what I got going on today, help, I need help?
Yeah. Yeah. So when it comes to tax planning, the very first step is getting organized because we need to know where you're at in real time. Today we're in, the month of September. So we've already had 9 months of income to show reported to the IRS. So we can forecast with the remaining 3.5 months we have left in the year to get a good idea of what is your estimated income going to be, your profit for your business or your W-2 income for the year, and what is going to be that liability. Because if we know that number today, that's the number that we want to change. But before we can jump into tax planning strategies and going down whether or not we should place your children on payroll, we kind of need to first understand what your goals and what your vision is. Some, taxpayers have a vision of, wanting to get married and move into a primary residence. And that could take some of the liquidity away from being able to do some tax planning strategies. Others have the goal from moving from one tax jurisdiction where you're paying taxes in a state like California to a state where you're not going to be paying state income taxes. So every single taxpayer has a different vision and they have different goals. Maybe you do believe in 401ks, maybe you don't believe in 401ks. So that shouldn't be a part of your tax planning strategy. But once your strategist understands your goals and visions, now they can go into the kitchen and start cooking up some strategies. But before they cook up some strategies, they better have access to your prior tax returns because they need to see what has been missed on your prior returns and were there any mistakes or omissions that we should know about that could cause some red flags in the future. And that's just because, Nicole, sometimes these IRS audits don't happen the same year you file your return. They'll happen a couple of years later. This is the first step of doing tax planning is really getting your customer or client organized, getting a projection of what their estimated liability is going to be based off of their business profit or what their W-2 income is, and then starting to really understand what their goals and vision are so you can start to shape a tax plan together.
Sounds amazing. I'm thinking about myself selfishly right now and just all the planning I could start doing now. Most entrepreneurs, obviously, they obsess over revenue, but some ignore entity structuring. What's a story where you've seen the wrong structure cost someone a lot of money, and what would have been the smarter play?
Yeah, absolutely. So I worked with this real estate agent and he came over to our firm after seeing my mother's videos. And this was early in my career. I was probably 24, 25 years old, but I had just spent time studying to get my tax license. And I started to understand a little bit more about entity structures. And at the time, I really was proficient in understanding the differences between LLCs, S Corps, C corporations, and being able to really communicate that well. We had a real estate agent that came into our office that had been doing about $500,000 to $700,000 a year. And he had been operating as an LLC, a sole proprietorship business. Because he was operating as an LLC sole proprietorship, he was paying into self-employment taxes, which is fine, right? Self-employment taxes is a tax that you pay into when you're self-employed. But here's the issue. If you're an LLC, you pay 7.65% of self-employment tax, which is Social Security and Medicare, by being your own employer. And then you also pay another 7.65% by you being your own employee, technically. That's a total of 15.3% on all of your business's profits. So just alone, he was paying almost 6 figures in self-employment taxes outside of his federal taxes and outside of his state taxes. What we chose to do immediately was switch him over from an LLC to an S corporation by filing a document called a 2553 form, just changes it over to an S corp, and immediately was able to wipe his taxes away. But the issue is that he had been making 500 to 700,000 in profit for over 20 years as a real estate agent, operating in the exact same way. He never chose to switch his entity structure, nor did it occur to him to speak with a tax strategist around whether or not he should be in a different entity structure. He just had a CPA that was filing his returns and told him to make his estimated tax payments. The issue was that he was just so upset at his CPA that his CPA didn't communicate this to him. And I had to remind him, listen, there is a difference between running a CPA office and running a tax advisory office. Most CPAs make their money off of filing as many tax returns as possible. So they're not really incentivized to make recommendations around strategies or entity structure shifts or anything complicated. They're incentivized to file an accurate and timely return. Whereas your fee to me I'm incentivized to look for opportunities to reduce your tax bill, to look for opportunities to switch your entity structure. So of course, I'm going to notify you of these things and point them out to you. And that gives you the confidence to build a tax plan. So entity structuring is so important. Right over $50,000 in business profit is when you should switch from an LLC to an S corporation, because you no longer pay self-employment taxes, you pay payroll taxes. And when we gave him a W-2 of $100,000, he only paid 15.3% on that 100,000. That other 400,000 of business profit was only subject to federal taxes by the IRS and state taxes by the state that he lives in. He essentially saved 15.3% on 400 grand.
That's huge, and especially for a lot of real estate professionals that follow us, I know that's going to be a big tip. In your experience, what's the tax mistake that you see even 7- and 8-figure business owners still make today, and why do you think they overlook it?
So there's two mistakes that even high net worth individuals make, which is co-mingling and failure to document. The reason why it sounds so rudimentary, but even, wealthy individuals miss out on this, is because of laziness and speed. When you're a business owner, you have the ability to set up your own personal credit cards and your own business credit cards. Your personal credit cards are for personal expenses. Your business credit cards are for business expenses. But sometimes business owners get lazy and they forget to bring their right business cards with them, and they use personal credit cards, or their personal credit card gives them more points than their business credit cards. So they use their personal credit cards to pay for business transactions. Just because you might be tracking the things that are going on your personal credit card does not mean that that's a great exercise for you to be conducting. And the reason why I say this is because I had a client one time get into a lawsuit, and the reason why the lawsuit was so serious for him was because he was commingling between his LLC and his personal credit card. He had an Amex Gold credit card personal, and he had an Amex Platinum business card. And because he was told that his transactions over $5,000 should go on the Amex business card, anything under $5,000, he was putting on his personal Amex Gold card. So he was using that Amex Gold card, accounting for all the expenses on there as business expenses, but it was a personal card. When he got caught into this lawsuit, they were able to pierce his corporate veil, meaning that not only was he liable for some of the debts and obligations that were going on inside of his LLC, he would now be personally liable inside of this lawsuit as well. His name was caught in the affidavit for the lawsuit as well, because they saw that he was commingling his expenses. So this is one reason why I always recommend business owners to have your business credit cards and run your business transactions through the business credit cards, and practice that discipline. Don't be lazy to run your personal transactions through your personal credit card. So absolutely, commingling is arguably the biggest one. Failure to document.
Yeah.
This one matters. When you start taking bigger and bigger expenses, bigger in travel trips, you're spending money on production companies, and you're running your own live events. Sometimes these business owners are spending upwards to 6 figures on certain travel trips that they're putting on, conferences, you name it, and they're failing to document what their expenses are for. You're paying $20,000 at this hotel, or $15,000 at this steakhouse. Who was there? Why did you spend this money? Because when these audits typically happen, the audit is on a profit and loss statement. Your profit and loss statement might say that you went to Mastro Steakhouse or you went to Sizzlers and you spent 15 grand. If the auditor questions why you spent $15,000 at that steakhouse, the next piece of documentation you need to have is a receipt. Let's say that you don't have that receipt. Then you had to have documented ahead of time the purpose of that business meal and who you were with. Most business owners don't do that, right? And so if you keep that copy of your receipt and you flip the receipt over and you write down who you were with and what was discussed, you can take a photo of the front of the receipt and the back of the receipt. The front of the receipt lets the IRS know where you were, what you spent your money on, and at what time you spent your money on, because there's the date, the time, and what you spent your money on the front of the receipt. The back of the receipt is who you were with and what was being discussed. Those are the 5 elements that are needed to protect you in an IRS audit when you have expenses that are being questioned. But most business owners are unaware of this, and they're They'll run out they'll run out the store without saving the receipt. They'll run out the steakhouse without keeping the receipt. And unfortunately, when you get into an IRS audit and you have so many transactions that you can't prove, you know what starts happening? You start negotiating with the IRS. All right, well, let's just get rid of these. Now you're taking $100,000 worth of expenses off your tax return, $200,000 of expenses worth off your tax return because you have no documentation and you're tired.
Right.
You're tired of fighting the IRS.
Yeah,
and this is what happens.
It sounds like these things come down to just like getting in the right habits and being organized enough. And you said before, like, don't be lazy. And it's the truth. It's easy just to like run out of the restaurant, put that, receipt in your pocket, lose it. It's like almost like before you even get up from the table, you got to like put that information there, make sure you have it organized. Do you make recommendations on like, hey, here are the best ways to kind of store and save this information if you do get an audit? Like, are you saying, hey, put it in a Google Drive, get it in a spreadsheet? What are the best tips you have for like consolidating and organizing these types of things?
Absolutely, Nicole. So I absolutely recommend that every business owner gets their own accounting software. QuickBooks is the tried and true software. It's been in the industry the longest, and it syncs with so many different programs. It's insane. But the part of the reason why I recommend QuickBooks is because QuickBooks has a feature that not only will track your miles, not only will allow for you to take pictures of your receipts, it allows for you to attach those pictures of your receipts to the transactions inside of QuickBooks. So what I do is with my personal assistant is I will actually send my receipts to my iCloud notes section. And then she'll go into my iCloud notes, because when you send it over to your iCloud note, a picture of your receipts, you have to write down a description and name the receipt. So I named the receipt and I put the description of who I was with, what was being discussed. She will go ahead and categorize those receipts onto QuickBooks and make sure that they're attached to every single transaction. So a great method to get in the habit is having those receipts saved in a place, and then at once a month, attaching those receipts to your transactions inside of QuickBooks.
Yeah, you got to have a system. You got to have a process. There's no doubt about it. You've spoken about often turning lifestyle into write-offs. What's the most surprising way you've legally helped someone convert a personal expense into a tax deduction?
Yeah, absolutely. So we had a client that was leaving to go to Europe, and he called me. He's like, "Hey, like this is going to be a big trip. I want to make sure that I can try to write this off." And I said, "Okay, well, it's going to be hard for you to try to write this trip off if you're not going there for business." He's like, "I understand, but what if I flew my plane?" And I'm like, "Yeah, you're a pilot, but you being a pilot and flying your plane to Italy doesn't all of a sudden make it a write-off just because you decided to take your own plane." And what he ended up doing was what I told him to do. I said, go on websites like eventbrite.com. What you're going to look for is you're looking for events where you can go and be educated or educate others in what you do. If you're a pilot and part of how you make money is flying private for people, wouldn't it be important for you to understand the newest laws, possibly the newest regulations around the certain types of planes that you're flying? Is there any types of events that are going on in the locations that you're wanting to go to? So he went on Eventbrite and he found 3 separate different conferences for pilots, and he even found a meetup group that the pilots were having. I shared with him how he can turn this into an entire business trip, because if we're spending more than 50% of the time on business, we can deduct the trip. And if he's leaving on a particular time period, which is not leaving on a weekend, leaving on a weekday and returning back on a weekday, I can wrap his weekend time too. So if he chooses to go hang out with his wife and he's on the beach, whatever, on a Saturday and a Sunday, I can still wrap the weekend in as business as well. So traveling somewhere, even though it may be viewed as a vacation, can be converted into a business trip if you're willing to put in the work. And he was willing to put in the work. He was willing to go into the conferences. He was willing to go surround himself with other pilots and learn and spend the time doing a little bit of aviation training to be able to go and enjoy that write-off of staying in that Italy hotel and being able to enjoy Europe. So
wow,
that was one story that I can say that was pretty awesome to help somebody with, because he immediately came back and shared the photos with our entire community, and he was very grateful for that.
Very cool. I think about when you brought that up, I'm thinking about, just about everyone now is literally documenting what they do for a living, right? They're making content and videos. It's such a big part of business today.
Mhm.
I think a lot of people have been personally kind of lost on it. Like, how do I get everything set up? What do I do? How should I organize this all? From a tax write-off perspective, what advice do you have for people that are doing content, trying to continue to do it in a big way and want to do it wherever they are? What are some of the expenses we can take when doing content?
So the IRS has a really awesome tax code that I like to share with people. One that I use almost like a sword that helps me defend myself against the IRS because you want to make sure that you know how to deduct things without fear of the IRS. And it's this code section. It's called IRC 162A. It's very simple. It states that a business owner can take a business deduction if the business deduction is ordinary, necessary, and reasonable to the business owner in the pursuit of income. So if I have the ability to make income by having a desk, a laptop, an iPad, cords, sound system, cameras, lights, and I can put my ideas out onto the internet and turn around and monetize it. Monetizing it means I'm going to make money from it somehow. I can deduct these expenses because these are all ordinary expenses, necessary expenses, reasonable expenses to my business in the pursuit of income. And I'm the one who gets to justify what is ordinary, necessary, and reasonable to my business. I mean, there's new businesses coming out every single day. I remember all these different NFT businesses that were popping up.
Hmm.
So people had different types of expenses that we never seen before, right? It doesn't mean that those expenses weren't ordinary to that business, necessary to that business, or reasonable to that business in the pursuit of income. So if you're ever questioning whether or not an expense is right for you to take, you have to ask yourself, does it fit underneath IRC 162A's guideline? Is this considered something ordinary, necessary, and reasonable? Is this going to allow me to be able to make income? Can I link it to the pursuit of income? And if you can, it's most likely a business deduction, a business write-off.
Absolutely. Yeah. I'm thinking about, a lot of people that are doing content travel so they can do content in different locations, and they're renting obviously equipment, sometimes cars, sometimes boats, sometimes conference rooms, and having to stay at hotels and travel to be there. And if
Yes,
you take, let's say, an ordinary, what would be a business trip, you're flying down to Miami for a few days and you say, hey, well, I'm going to shoot content for 50% of that time. Let's say I'm going to be shooting content, creating reels.
absolutely.
It then becomes a deduction that you can take.
Yeah, you're putting in sweat equity,
Hmm.
not for the fact to just go on a vacation, but you're putting in sweat equity because you are trying to make money, right?
Mm.
You have a bona fide intent on why you're there. You're not there just to, hang out. You're there to actually make money. And, as long as you are reflecting that in how you move as a business owner, there's nothing wrong with where you choose to go do business, even though there might be beautiful sandy beaches
Hmm.
in Miami.
Hmm.
There's nothing wrong with that.
Awesome. What's the loophole you think most entrepreneurs seem to be too scared to use, but if they truly understood it, it could really transform their cash flow overnight?
I mean, the Augusta Rule is not really a loophole, but it's definitely something more entrepreneurs need to utilize. And I think there's fear around utilizing it because there is an absence of tax professionals that truly understand it.
Mm.
And it's not too hard. The Augusta Rule is a strategy that allows for you to rent your primary residence to your business for 14 days, completely tax free. You have to choose a fair market value rent by pulling comparable rates in your local market or local area based off of your property size and location, and you can create a contract between the business and yourself. Pretty awesome. Now you're deducting rent and essentially writing yourself a check every day over the course of 14 days for renting your business to your house. Now you need to have a real business intent of what you're doing at your house, whether it's launching a product, hosting meetings, bringing your team over, running a business party, whatever it is. But those 14 days are completely tax free. So it's been a way to immediately turn around and give people access to tax free money.
Let's talk a little bit about real estate. I think I've heard you say before that there's a lot of advantages in short-term rentals. Could you give us some
Yes.
insight into how we may be able to use short-term rentals? I think you've said to offset W-2 income.
Yes, absolutely. So short-term rentals can offset all forms of income, whether it's W-2, 1099, capital gain, Social Security, pension, 401k, retirement, you name it. It has the ability to offset all forms of income. It makes it arguably one of the most important tax strategies because depreciation it's a powerful, powerful expense that you do not have to fully pay for. When you buy rental real estate, you're typically taking out OPM, other people's money. You're going to go to the bank and finance the property at typically, 80% loan to value. You're going to take out an 80% loan. You're going to put 20% down. That being said, you have purchased an entire asset that you get to completely write off. Let's say, for example, you buy a $1 million property just to make it nice and even.
Mm-hmm.
And when you close escrow, they give you the closing statement. They say, of this $1 million, 800 grand is going to be dedicated to the building and 200 grand is going to be dedicated to the land. You get to deduct that 800,000 of building on your tax returns as depreciation over the course of 27 and a half years. Now, that's pretty awesome because that's essentially a write-off that's been given to you. It's a tax incentive that's been given to you as long as you own investment real estate, whether it's passive or it's active. But the real kicker here is, how can we use that depreciation to create an active deduction? Because if you have a W-2 or if you're self-employed, you have active forms of income, not passive income. So you would need active deductions on your tax return. This is where the cost segregation study comes into play. The cost segregation study is a strategy that allows for you to accelerate depreciation. And on average, you can get around 30% of your building's value as a year one tax write-off. So if we have $800,000 of depreciation, we'd be looking at close to $240,000, $250,000 of year one tax write-off. So essentially, with my down payment of $200,000, I'm getting almost $250,000 back in a tax write-off. It's like the government is paying me to invest in real estate. But here's the issue. If I do that cost segregation study and I have that $250,000 loss, can I use that loss to offset my W-2 or my 1099 income? And this is where the short-term rental strategy comes in. Normally, real estate's passive. You have long-term tenants that are staying in your property, you're collecting rents. And so it's very, very hard to show that your real estate is active unless you qualify as a real estate professional, someone who can spend 750 hours in the year actively managing their rental property. And they are also able to show that they're spending at least half of their time or more in real estate than any other job that they may have, which is incredibly hard to do. So most people can't qualify, but you can qualify for the short-term rental strategy if you have enough time. The short-term rental strategy does not require 750 hours. It only requires 100 hours, but here's the kicker. Each tenant can only stay in your property on average for 7 days or less in the year, meaning that people are coming in and out all the time on a transient basis, which is more like a hotel or a motel-like business. This keeps it active and allows for you to have active losses on your tax return when you choose to do a cost segregation study. So what some of my clients will do, Nicole, is at the end of the year, typically in the months of, October, November, and December, is they'll close escrow on a short-term rental, will perform a cost segregation study, manage it till the end of the year, get their 100 hours, and then in that following year, they'll decide whether or not to convert it to a long-term rental.
Wow. So interesting. I think about, there's a lot of, we do a lot of condo-tel financing, and I think condo-tels are such a kind of unique asset class in the real estate world because you can use and occupy it as a residence if you want to go on vacation, and then you can rent it. But in those instances, the hotel helps in the management component of it. But I would imagine you're still obviously actively involved in managing that short-term rental as well. But I think there's just so many plays here that people can use in the short-term rental space. Obviously, you have to check with, the municipality and what their requirements are with short-term rentals. I know some people get caught up with that. When you think about kind of longer-term strategies, like clients that are thinking about strategizing over multiple time horizons, which strategies are best to start working on earlier versus later?
Strategies around converting money into Roth money. So if you would have caught me 7, 8 years ago, I would have definitely been stuffing way more money into my Roth 401k. But at the time, I was using some of it to kind of start my business,
Mm-hmm.
right? So, I think that we sometimes neglect that converting money into non-taxable dollars is a strategy. That is a strategy. If I presented you with the short-term rental strategy and we get into a short-term rental, you're able to take that $250,000 loss rather than just you offsetting your W-2 taxes and then you having a lump sum of money. Why don't we go ahead and max out your Roth 401k, knowing that we're going to pay the taxes up front, but we got those tax savings with the short-term rental. Now that's $24,000, $25,000 in your 401k that will never be taxed again. It will grow tax-free. When you pull it out, it's tax-free. And that is tax-free wealth, if you ask me. I believe that more people should be focusing on building up Roth dollars in their earlier years because that is the long-term strategy versus constantly having to focus on tax deferral strategies, we should be focusing on tax elimination strategies, which is putting money into Roth accounts.
And now for business owners, is it still a Roth or is it a SEP that you contribute towards, or which are they the same? How are they different?
Yeah, absolutely. So if you're self-employed, you can set up a solo 401k if you're the only employee of your business. If you have multiple employees, you could choose to structure it as a SEP IRA. If you have a SEP IRA, you can contribute up to 69,000 in the year, which is amazing. And that SEP IRA can be converted to a SEP Roth IRA, which means you can convert those dollars into Roth dollars, pushing all 69,000 into the Roth account. Pretty awesome.
Yeah, and then so that money grows as it's invested in whatever it may be, stocks or indexes, and once you pull that out, it's tax free.
That is 100% correct. Once you pull it out, it's tax free. That is what we all want. We want to have not, hundreds of thousands, hopefully millions of dollars sitting inside of tax-free accounts, just growing for us without us having to worry about taxes as the money continues to grow.
Talk to us. I've heard you make a lot of videos around, how to integrate your family, your spouse, your children into your business. What are some of your best tips and strategies for people to integrate family and to take some deductions?
Yeah, this is a great question, and one that comes up pretty often because most business owners have, children that they want to incorporate into the business somehow, some way without causing a tax problem. And if you do it incorrectly, it can lead to payroll taxes and tax returns, and it can get a little bit confusing. How it works is we structure children on payroll through what's called a family management company. Rather than having your S corporation place your children on payroll, which will lead to you having to pay payroll taxes in the amount that you issued to them in a W-2, you can structure this so that you have a LLC that operates outside of the S corporation. The S corporation would pay a management fee over to the LLC, the family management company, and then that family management company would then disperse that revenue to its children, which would be either one, two, however many children you decided to employ. The IRS will allow you to pay children up to the standard deduction, which is $15,750 in the year of 2025, which is pretty awesome. So that means that you can essentially move over from your S corp to your family management company. 15,750. Your S corp receives a deduction, and then inside of that LLC, you pay out your child 15,750, and now there's no tax return needed, at least at the federal level, and then you also won't have to pay any taxes either at the federal level. So pretty awesome.
So once you pay your children, is there any requirements on where that money goes from there? Does the child need to have it in, a particular kind of account, or could it go into a joint account with your child? How about that post kind of distribution of pay to the child?
Yeah. So absolutely, you're going to set up a bank account for you and your child, and you'll have management rights over that account. And then if the parent is really savvy, Nicole, what they'll do is they'll set up a custodial Roth IRA, because essentially the money that neither them nor the child pay taxes on can then go into a Roth IRA and continue to grow tax-free. There's studies that show that if you just do this one time at the age of 5 for a child and just put in the $6,000 that's needed, that by the age of 60, that child should have nearly $1,200,000 sitting inside that Roth IRA with just one simple contribution. So again, it's very powerful and a great wealth building tool for families when they choose to focus on it.
I imagine some of those strategies are like for, a child to be integrated into business. I'd imagine they'd be part of possibly like marketing or advertising, let's say for the company, or maybe a part of, I see a lot of times people have their kids on their podcast or part of their content, asking questions, really playful way. What are some ways that your children can get integrated in a legal way at a young age?
Yes, absolutely. So there does need to be a contract that establishes the bona fide work that your child will be doing. So you have an employment contract for your child.
That's
I know
great.
It sounds kind of awesome, but yes, it is pretty cool. And when we see most children that are extremely young, and I say extremely young, I'm talking, around the age of like 4 or 5 years old, the only things that you're doing at that age is probably being a child model. You're probably not earning $15,000 a year. You're earning closer to that Roth IRA contribution amount, closer to $4,000 to $6,000 a year. And that's fairly reasonable relative to the amount of photo shoots you might conduct with your child in that year. There's only so much content, only so many photos you can probably put on a website before it starts to look a little too weird, right? Mm-hmm. So that's, when we're seeing children in that younger age, as children start to grow up, they start to actually become helpers. Some of the children that we see play a big role in the property management companies, because when you're managing your own short-term rentals or you're qualifying as a real estate professional, it may make sense to have an LLC management company and have your children show up to the property, help you do certain things, pick up staples off the ground, send emails, you name it, you have it. But that's definitely a role that I'm seeing, children play. And then janitorial services, absolutely. Taking a home office deduction, you could choose to have your children help out in janitorial services at the house. These are just simple ways for us to be able to create employment contracts for the children.
Incredible. Incredible. I think a lot about real estate investors. We work with a lot of real estate investors. We send these podcasts out to them as well. What are some tips for, how to hold these entities, how to defer taxes when buying and selling? Give us some of your best tricks of the trade for our real estate investor crowd.
Yeah, so there's phases to asset protection. The first phase is just having an LLC in the state that you own the investment property, which is great because you've separated the liability from yourself, and you've made sure that you have that income from the property getting distributed into the LLC holding company. Then you go into phase two, which is setting up a parent company. Parent company is normally going to be in a state such as Wyoming, Nevada, or Delaware. Part of the reason why we typically go with Wyoming is because Wyoming has a court of chancery. They've decided to establish a whole court system that deals with just business owners and landlords, which is pretty awesome. And then on top of that, it doesn't require managers or members of LLC's names to be public information and at the Secretary of State level. So if someone tried to research who owns that LLC, you won't be able to figure out who owns that LLC. You'll just see the name of the LLC. You won't see who it's associated with or the address that it's associated with, just the registered agent that it's associated with. So this creates what we call a layer of anonymity. It makes you a little bit more anonymous in the eyes of your tenants. And then as you start to build your real estate portfolio, that parent company will actually be the owner, 100% owner of your single member LLCs. So every new LLC that you create for asset protection, it'll be owned by your parent company that's in Wyoming. Over time, what we also see is real estate investors set up management companies because you might want to eventually manage your own properties yourself, set up your own systems for managing your own property, hire your children through the management company, take additional expenses, vehicles, you name it, through the management company. And so that LLC management company is normally set up in the state that the client or taxpayer lives in. So that's more or less the progressions of how we see LLCs being structured for real estate investors. And then when it comes to exiting out of real estate, I like to recommend the 1031 exchange strategy only because the 1031 exchange is the way in which you avoid taxes when you're trying to exit and still remain in real estate. When you're claiming depreciation on your tax returns, whether you do a cost segregation study or not, depreciation recapture is a real thing. It is something that comes back to you in the form of ordinary income taxes. So any depreciation that was claimed on the tax return will get reported back to you as ordinary income. And then any gain that you experience for when you sell your property for more than what you bought it for is subject to capital gains taxes. So you kind of have two different forms of taxes that you pay if you choose not to do a 1031 exchange. But if you use the strategy IRC 1031, what you're saying is that I'm going to locate a property that's equal in value or greater in value than the property that I'm selling. And then I'm going to identify it in a 45-day period, and I'm going to give it to my 1031 exchange accommodator and let them know this is the property that I wish to buy. Then I'm going to sell my existing property, roll over the proceeds to my 1031 exchange accommodator, and my 1031 exchange accommodator uses the proceeds to go ahead and close escrow within a 180-day period of me engaging on this transaction. When done correctly, I never actually touch the money when I sell my first property. All proceeds roll into my next property. And now I've completely avoided capital gains taxes. I have a brand new property. And guess what? I could do a cost segregation study on that new property as well and continue to save money on taxes. So this is ways in which, one, the wealthy have continued to be able to stay, tax-free, but more importantly, how the IRS has created incentives to keep you in real estate.
Absolutely. Love these tips. These are great questions, and thank you for your insight. I'd love to do kind of a this or that tax edition, and then I'd like to let the audience know how they can get in touch with you, how they can learn more, and possibly set up a strategy session. So, all right, this or that tax edition. Home office deduction, legit or sketchy?
Sketchy. I don't like home office deductions because they're too they're messed around with too much. I see most business owners trying to take 50, 60% of their home square footage as a home office deduction. And the home office shows up in your individual tax returns, which sticks out like a sore thumb to the IRS. It's a huge red flag. I'd rather you take the Augusta Rule or create a leasing agreement and lease a portion of your house to your business, so you're not reporting a home office inside of your tax returns.
Awesome. Buying a car through your business, smart move or audit risk?
Smart move, separating the liability from yourself personally. Absolutely, that's a smart move.
LLC taxed as an S corp, best of both worlds or overhyped?
Best of both worlds. You get the flexibility of being in an LLC, but the taxation of being an S corporation. I almost view it like putting on a jacket, right? It's like I'm walking into the store without a jacket, and when it gets hot and I'm ready to file my tax returns, I can put my jacket, or when it gets cold and I'm ready to file my taxes, I can put my jacket on, and that's the S corp.
Love it. Keeping receipts versus bank statements, which matters more?
Receipts. Bank statements don't tell me anything. If you went to Home Depot and you spent $1,000 at Home Depot, I don't know what you spent your money on. Maybe $500 is for your personal toilets at your personal house, and the other $500 is for your business toilets at your business office. We need the receipts to know what those transactions were for. So yes, receipts always trumps bank statements.
Real estate professional status, a powerful tool or an IRS red flag?
No, not an IRS red flag. When done correctly, it's arguably one of the most powerful tools you can leverage, and one that is done pretty regularly at our office. If you need any help, you can reach out.
Meals and entertainment write-offs, 50% deduction or 100% distraction?
Not a distraction. We love food. I'm a big foodie. I always make sure I got my meals on my tax returns. Even though it's 50%, I'm glad we're able to deduct it. Absolutely something you should take advantage of.
Opportunity zones, gold mine or gimmick?
Not a gimmick at all. If you want to avoid capital gains taxes, you can roll over your capital gains proceeds into an opportunity zone. As long as you're willing to remain in an opportunity zone for 10 years, you can completely avoid capital gains taxes. Pretty awesome technique. Most people don't talk about it. I'm glad that it's in the tax code.
Awesome. Crypto gains, taxable nightmare or hidden opportunity?
I mean, it's only a nightmare if you have a lot of money, right? And I think it's awesome if you are investing in crypto. I think it's important for you to hold on to it. But if you are selling it, you do need to have a tax strategy in mind, because most people who are trading crypto have short-term gains, which means that they're going to pay ordinary tax rates. So if you don't have a plan in place, you can build a plan before December 31st to mitigate liability.
Amazing. Or move to, what is it, Wyoming or something that doesn't do, everyone's popping up with like no cap gains on crypto. Is that actually happening?
Or Puerto Rico.
Or Puerto Rico. You have to move and live there for...
That's just at the state level. You still have to pay at the federal level, right?
Yeah.
So you'll still owe IRS, but maybe avoid the state taxes.
Well, I think, look, it's like a unique situation we're in with all of the remote work that exists, that people really do have this opportunity to decide where they live and, and work remotely. So it's legit. Trust, which I didn't ask you about, but only for the ultra wealthy, or every entrepreneur should consider?
Every taxpayer should consider it, whether you're an entrepreneur or not. A trust is extremely important to have. It's just a means for you to pass something off to your beneficiaries the right way. And we've seen wealthy individuals all the way down to non-wealthy individuals fail to plan for when that day comes, because you never know when it's going to come. The issue is not the fact that you didn't have a plan. The issue is the fact that your children, the people you care about most, are mourning your death, and they have to worry about your finances at the exact same time. That's the issue when you choose not to plan.
Very true. All right, last one here. Life insurance inside a business, wealth hack, or waste of money?
Life insurance inside of a business is strategic depending on the size of your business, because you could retain key employees by setting up key person insurance policies or executive bonus plans with life insurance attached to it. There's different ways in which you can utilize insurance to secure and retain top talent. So I wouldn't say it's a waste, but it's absolutely not something that's for a newbie or a new beginner. It's absolutely for an established business owner that has retained or has key employees that they need to retain.
Amazing. Well, I will definitely be reaching out to you. I have real estate investments. I own a construction company. I have the $1 billion studios business for content, and so much to think about. It's just almost overwhelming at times when tax season comes around now and you're thinking about, so many different entities. I can't imagine what you go through personally getting everything together. But tell our audience, how can they get in touch with you? How can they set up a conversation, or how do they just learn more about what you're putting out there today?
Yes, absolutely. So first off, I would love it if you guys could go to our website, www.taxalchemy.com. Take a look at our testimonials and some of our sample tax plans. That'll give you a better idea of some of the strategies we utilize, the types of incomes that our clients are making, and better yet, the process of tax planning and what it could look like. If you're interested in learning a little bit more about some of the strategies we discussed here today in more of an open format, visit our YouTube at Karlton Dennis. We have 1 million subscribers on that platform. We've been doing a great job of teaching tax strategy broken down in a great format. And then if you would like to reach out, feel free to shoot us a message on Instagram. We're also Karlton Dennis on Instagram, as well as Tax Alchemy Advisors.
Amazing. We'll put all this in the description notes below. If you know someone that could use some tax advice, share this episode with them. Comment below if you have any questions. We can certainly get in touch with Karlton to get some answers. And start strategizing today. It's got to be part of our plan. Karlton, thank you so much for taking the time to join us today.
Absolutely. Thank you for having me.